All right, let's jump right into this explainer. If you've looked at any financial news lately, it's so easy to get caught up in the AI hype, right? The latest software, microchips, the flashy stuff. But today we're zooming in on the complete opposite of that. We're looking at the gritty, physical reality of moving actual things around the globe. And specifically, we're going to examine a massive catalyst that could completely upend one of the quiet giants operating right at the heart of that space.
Because think about it like this. AI gets all the headlines, right? And semiconductors get all the money. But there's another business quietly moving almost everything the global economy actually needs to function. While tech gets the spotlight and all the investment dollars, there's a Danish company called DSV that is quite literally the backbone of global physical trade. Cars, electronics, medical gear, raw materials, you name it, DSV is right in the middle of it. They aren't just pushing boxes around, they are building one of the absolute largest logistics networks on the planet.
So Section 1, the quiet supply chain giant moving the global economy. Let's break down exactly who DSV is and why their network scale is just so incredibly massive. When a company makes a smartphone or a car, that product goes on a massive journey. Factory to port, port to warehouse, then a distribution center, and finally to the customer. Well, DSV is involved in almost every single step of that journey. Sea, air, road, rail, contract logistics, the whole shebang. And in logistics, it is all about scale and network density. The more volume you have, the better your purchasing power, routes, and warehouse capacity. It's basically a giant snowball effect. And DSV, they've spent years just gobbling up smaller logistics firms to build out this incredible global scale, which gives them a serious competitive edge.
Which brings us to Section 2, the DB Schenker acquisition, a make-or-break catalyst. This is the big one, folks, a truly transformational deal for their future.
This massive acquisition expands their footprint dramatically, but it's easily their biggest opportunity and absolutely their biggest risk too. It really comes down to two high-stakes outcomes. On the good side, DSV nails the integration. They combine the companies, slash duplicate costs, supercharge their network utilization, hit their synergies, and boom, earnings per share go up. But if we look at the bad side, man, if this integration gets messy, costs are going to spike, frustrated customers will jump ship, those promised synergies vanish, and debt piles up fast. This is literally a make-or-break catalyst for their valuation.
Moving on to Section 3, Global Trade and Tariff Risks, Navigating Economic Headwinds. Because DSV operates on such a massive international scale, they're basically a barometer for the global economy. So we really need to look at the macroeconomic headwinds here, especially the impact of tariffs.
Just watch this cascading domino effect, because this is a huge risk for any logistics giant. Say US tariffs go up. Suddenly, Chinese exports might drop. That shrinks overall global trade volume, meaning freight demand falls. And when demand drops, you get intense pricing pressure among the logistics providers, which takes an immediate, direct bite out of DSV's profit margins. It's crazy to think about, but a policy decision on one side of the globe literally hits the bottom line of a Danish logistics company almost instantly.
But let's look at this impartially. Tariffs aren't purely a negative thing here. They are massive disruptive forces. When tariffs hit, companies often have to move manufacturing. They need more inventory, and overall logistics get way more complicated. And that disruption, it forces companies to totally redesign their supply chains, which actually creates new, highly lucrative demand for logistics players. DSV can make a ton of money stepping in to help these multinational corporations restructure their entire global footprint. So it's a threat for sure, but it's also a profound shift in the market that a scaled player can capitalize on.
All right, Section 4, the financial scorecard, tracking the right metrics. Let's dig into the financials and see how tracking the right numbers builds into a highly focused, actionable watch list for everyday investors. Now, the absolutely crucial takeaway from this scorecard is that you cannot just fixate on top-line revenue. Actually, revenue is only rated as a 3-star metric here. Why? Because in logistics, especially during a mega merger, volume doesn't always equal profitable volume. You really have to track the 5-star metrics: EBIT margin, free cash flow, net debt, and right now, maybe the most important one, integration synergies. If you want to understand DSV's health today, you have to obsess over margin and cash flow, not just how many containers they're moving.
And before we model out the actual scenarios, we have to ask the billion-dollar question, literally. If DSV is spending billions to buy DB Schenker, how quickly do they get their billions back? Investors have got to hawk eye those cost synergies, employee reductions, facility consolidations, and debt repayments. At the end of the day, an acquisition this massive only works if the return on that invested capital actually outpaces the cost of the capital over time.
Okay, Section 5, bull versus bear cases, compounding machine or debt trap. Let's actively weigh the two main scenarios that analysts are modeling out for DSV right now.
Let's kick it off with the bull case. Imagine a scenario where global trade holds strong or even recovers. Freight volumes climb. Because DSV just bolted on DB Schenker, their network utilization shoots through the roof. Margins expand, they hit their synergy targets perfectly, and free cash flow just explodes. With all that cash, they pay down debt fast, EPS surges, and their overall valuation gets a huge bump. In this scenario, DSV operates as an absolute compounding machine, buying competitors, stripping out costs, printing cash, and doing it all over again.
But flip the coin, and the bear case maps out a very different reality. Imagine a global recession hits exactly as they're trying to integrate DB Schenker. Trade volume drops, pushing freight rates and revenue down. At the exact same time, the incredibly complex acquisition integration costs start spiking. Suddenly, cash flow is tight, meaning their debt load stays dangerously high, and rising interest rates make that sting even more. Margins collapse, earnings disappoint, and the stock takes a beating. It's a textbook map of how a poorly timed economic downturn mixed with integration headaches can create a massive debt trap.
Finally, Section 6, the final investor verdict, looking at a strategy for August 2026. Pulling all of this analysis together, how should we actually approach DSV as a specific investment strategy today?
When you look at the holistic investor scorecard for the company, it's sitting at a very strong 8.8 out of 10. Now keep in mind, that is despite a clearly designated medium-high overall risk profile. Those high risks come from global trade exposure, freight pricing volatility, and of course the huge execution risk of the integration. But it still pulls an 8.8 because their global network scale is simply unmatched. They have strong long-term logistics demand and ridiculous cash generation potential if they can actually make the consolidation work.
So, breaking down the actionable strategy, think of it like clear traffic light triggers. Green light, buy on a pullback. The perfect setup is if the stock price dips but those DB Schenker synergies remain on track and debt is dropping. Yellow light is hold. You sit tight if the integration is progressing, margins are stabilizing, and temporary freight weakness seems manageable. But the red light, meaning sell or swiftly reduce your exposure, flashes if the integration structurally breaks. That means if debt unexpectedly rises, synergy targets are repeatedly missed, and free cash flow deteriorates.
Which brings us to our final, really fascinating thought. The researcher put it perfectly. Every time a company moves a product across a border, somebody gets paid. Look, global trade, supply chain restructuring, industrial logistics, they aren't stopping anytime soon. The opportunity here is absolutely enormous, but the central question remains, can DSV actually manage the staggering cost and complexity of swallowing DB Schenker to dominate the market and capture those profits, or will the sheer weight of the acquisition drag them down? Keep a very close eye on their margins and debt levels to find out.